Hello class, welcome to another presentation by Professor Choi. Today we're going to be covering companies, the stock market, and corporate governance in general. Alright, so this is one of those chapters where you have lots of different information that it's useful, and it's useful to know to move on to further chapters. So first thing we need to talk about is the difference between assets and liabilities. An asset is basically anything of value owned by a person or a firm. You can think about your refrigerator, your computer, your car, if you have a house, any financial securities such as bonds, stocks, or treasury bills. Liability is anything that you owe to someone else. Like if you have a car loan or a house mortgage or credit card debt, that's a liability. Now the reason this is important to understand the difference between assets and liabilities is because it affects the way we look at things and it affects contracts. So an asset a lot of the times comes sort of attached to a liability. So let's say you purchase your new car, and that will be your asset. Liability is basically the fact that most people don't pay cash for their new car, they get a loan, so it comes attached with a car loan. Now the problem with this particular asset liability combination is that they both don't have the same value over time. So if we put time on this axis and you put value in dollars on this one. Now let's say you bought a $20,000 car. Let's say that it was new. Okay? So if you buy a brand new car, a brand new $20,000 car, that is going to be the asset, the amount that you're going to be, that's going to be on the loan. Again, unless you put a down payment. But this will be the amount that you put on the loan. Now your loan is going to move down by the amount of your payment. So it moves down kind of like on a straight line. As you pay it off, basically. So if you make the same payment, then over whatever time you structure your loan for, it would eventually wiggle down to zero. Now remember, your loan in this case is your liability. Alright, now let's talk about the value of your car. New cars tend to depreciate a lot in the first 3 years or so. So first thing that's going to happen is, as soon as you drive it off the lot, it's going to lose about 10% of its value. So the moment you drive it off the lot, value goes down by about 10%. And that's because your car just went from being new to being used. Then after that, the value of your car is going to drop pretty rapidly to about half of its value within, say, 3 years or so. 3 to 4 years, your car is worth about half of what you bought it for. And then the value is kind of going to stabilize, and then it's going to have some kind of residual. So in other words, the value never really goes down to zero. There's always something that somebody will give you, even for a pile of junk. Somebody will pick it up for some money. Alright, now the quickness that this takes to cross this right here will tell you about how quickly the asset is worth more than the liability. Notice that because it goes from new to use pretty quickly, then you start your loan payments upside down. And what upside down basically means is that the liability value is greater than the asset value. All right. Again, why is this important? Well, imagine that somewhere around here you can't make the payment. Okay? And you decide, well, I'm going to turn in the car to the bank. Well, the problem is that the value of your car is lower than the value of the loan. The bank is going to go ahead and try to sell your car, and they're going to get this value. But you are on the hook for the entire value of the loan. So even though you turn in the asset, you still owe, in this case, the bank, the difference between the value of your liability, the car loan, and the value of the asset. All right. So again, it's good to understand the difference between assets and liabilities. A lot of the time, people tend to buy things that are actually more liabilities than they are assets. And it's very obvious that a lot of people don't quite know the difference. A few interesting facts, by the way, maybe you might have not noticed, but about half of the people who win the lotto usually lose the money within 5 years. And that's usually because they tend to grab a bunch of assets that they cannot maintain. So think about the moment you buy a huge mansion, you're thinking, okay, well, I can make the payment. But the question that you got to ask yourself is, can you pay the taxes forever? Because the taxes are going to be huge. Can you maintain it forever? I mean, if it has a big pool, you got to talk about maintaining that, cleaning it. Anything that breaks on it, you got to fix it. So if you cannot maintain a certain income for a long time, then the value of your wealth will decline very quickly because you buy yourself something that is more of a liability than an asset. All right, let's talk about the different types of firms. A sole proprietorship is basically a firm owned by one individual. The major advantages of having a sole proprietorship is that you control it. It's easy to operate, and you have single taxation because you basically pay your taxes at the end of the year together with your individual income taxes. You just file a separate schedule. The major disadvantages of having a sole proprietorship is that you have a limited ability to raise funds because basically the funds is whatever comes out of your pocket plus the business. And you have what we call unlimited personal liability. Now let me try to explain the unlimited personal liability problem. Most people who are out there doing business are sole proprietorships. If you work, for example, for a company like Uber or Lyft, right now most people who work for Uber and Lyft are individual independent contractors. You will know that you're a sole proprietorship for the purpose of the IRS, by the way, when somebody pays you with a 1099, which means that you are an independent contractor, not an employee of the company. Or when you basically just get paid, you do business and people just pay you for what you do without a corporation, without a structure. So if you're a sole proprietorship, the biggest problem is that you have unlimited personal liability. What that basically means is that you and your business, for the purpose of the IRS and the law, is the same thing. So if you do something wrong while doing your business, then people can come after all of your assets, not just the business assets. They can come after everything. They can come after your bank account, your retirement account, everything you have. Okay? That's what we call unlimited personal liability. In a partnership, a firm is owned jointly by two or more people. The major advantages is the ability to share work and share risk. Major disadvantage is the unlimited personal liability problem that now applies to both of you and your partner. A corporation is basically a legal form of business that provides owners with protection from losing more than their investment if the business fails. Now, the reason a corporation provides protection is because a corporation is basically a completely separate entity that is created for the purpose of doing business. So in other words, a corporation, it's like a separate individual. So A corporation, for the purpose of law, is treated like a separate thing. You're like another separate entity. The major advantages of having a corporation is that it has limited personal liability, which is what I just explained. It's treated as a separate thing. So if you do, if something happens while you're doing business on behalf of your corporation, worst case scenario, you can lose the value of the corporation, but you won't lose any personal assets. That's a major advantage. Another advantage of having a corporation is that you can now issue stocks and bonds. Now, disadvantages of a corporation is that they tend to be more costly to organize because it's more government regulated. For example, corporations require you to have an accountant or a CPA that keeps track of your corporation earnings, and it prepares a book, basically financial paperwork at the end of the year, so you can distribute to all the shareholders of your company. So they're in charge of creating financial statements. There's also an issue of possible double taxation when you have a corporation. Let me try to explain that a little bit. So imagine that this is the amount of money that your corporation makes. So this is your total revenue. And imagine that this is the amount of cost of doing business. Let's call this total cost. All right, so your operating expenses is this number down here. That's your sales amount, and the difference between those two is your profit. Okay, now taxes are paid on profits. They're not paid on costs or revenue. They're paid on profits. So you pay taxes on this. All right, imagine that this portion you got to send to all consignment taxes. Okay, this is the tax amount. This is a corporate tax amount. Now the rest that you see here, you could distribute in multiple different ways. Now let's just slice it in two and say, okay, well, this half we're gonna keep as retained earnings for the company, and then we're gonna be using that to, I don't know, buy another warehouse, get better equipment, etc. This portion here, let's say I want to give it to the owners of the company. So we take that out and give it to the owners. Now, because the owners of the company are separate entities from the company itself, then they got to pay income taxes. So out of the amount of money that they make, a portion of that they got to pay taxes on as well. All right, so what that basically means is that when you have a corporation, you pay taxes here as a corporate structure, and then a portion of what you send to the owners, it also gets taxed. So you experience what we call double taxation. All right. This particular slide was made for the state of Florida. So in the state of Florida, you have a third option. It's called a fourth option. It's called a limited liability company. I am not quite sure if limited liability companies are available in all of the United States, but a limited liability company is basically treated as a corporation for ownership, but as a partnership for tax purposes. So you are allowed to issue stocks and bonds, and you are a separate entity, but you are treated as a partnership for the purpose of taxes. So you do single taxation at the end of the year, and each individual partner declares a portion of the income in their income tax. If you happen to be a small corporation, you can file on the subchapter S, which is for small corporations, and they have a different, basically, tax schedule for you. All right, let's talk a little bit about corporate governance. Most corporations operate pretty independently from whatever the government entity wants you to do, in the sense that corporations have their own way of behaving. They have a basic structure sort of at the top, but anything beyond that, the corporation could be whatever they want to be. At the top of every corporation, there's something called a board. The board of directors, the board of whatever you want to call it. Most people call it board of directors. Now, the board of directors is basically where the owners are, and then the advisors to those owners. So it's owners and advisors. These are the people who basically hire and fire the top management team. Now, top management team is usually your CEO, your CFO, your COO, or all these other interesting names, or your president, vice president, and again, whatever other name you have for it. All right. So again, all companies have boards, and the board is where the owners are. Then you have your top management team. Now below that, corporation could be anything it wants to be. So the way a corporation is structured, the way they do things, how they manage stuff, the way they follow particular procedures, etc., all of that behind this, below this is very much whatever they want to do. All right, sole proprietorships are the largest in number of companies. Most companies out there, if you count them, are sole proprietorships. Corporations are only about 18% of companies in the United States. But corporations are the number one in revenue. They accumulate about 82% of all the sales and 60% of all the profits. Now, one of the problems that you eventually tend to have in corporations is this problem of separation of ownership. In other words, the board becomes different people than the CEO and the president. This eventually creates what we call the principal agent problem. The principal agent problem is a problem caused by the agent, aka management, pursuing its own interests instead of the interests of the principals, aka the owners. The board, if you talk to most owners of a business, what they really want is they want the business to be alive pretty much forever. And they want the business to perform well and do what it's supposed to do. Okay? So they want to create a structure that is alive forever, that can survive, that is resilient. But if you talk to CEOs and CFOs, in front of the board, they'll tell you that they want to do the same thing, but they understand differently. They understand that they have a limited life expectancy. In other words, CEOs are normally not CEOs forever, which means that if they want to make money, they got to figure out how to do that during the time that they are CEO or, running things. As a consequence of that, management is usually more willing to take risks that the owners probably do not approve of. But because the owners on the board are not running the company on a day-to-day basis, sometimes it's a little difficult to see what the management is doing. All right. Now imagine that you want to start your own business. Most people who start their own business, the first amount of money that they have is normally coming from their own funds. So they basically have to save money, or they have to use their own funds from family or whatever to create the business. It's not only until the business gets to a certain size that other people are willing to take a chance on you. So a lot of the times you can't really bring in partners or things of that sort. It takes a while for businesses to be able to borrow funds from banks and other things of that sort. One of the misconceptions that people who want to start a business have once in a while is that they think that others are willing to take a chance on their ideas. Very few happen to be like that. Most people would not take a chance on someone's idea until you have actually developed more than just an idea. So when you want to take on partners, most of the time those partners will not come in and help you boost your business until you have a running business already. They will not come in on the idea portion. So most businesses need to be created and started and all of that and established by the people who started the business, and then banks might be willing to take a chance on you and give you a big loan and things of that sort. All right, now let's talk about what exactly are stocks and bonds. So corporations can issue stocks and bonds. A bond is a financial security that represents a promise to repay a fixed amount of money in the future. And a stock is a financial security that represents partial ownership of a company. Usually it pays what we call dividends, but not necessarily. All right, so let's talk a little bit about the difference between bonds. So a bond is basically a promise to repay. So bonds are basically IOUs. You know, it's I owe you money and I'll pay you later. So bonds usually have what we call a face value. They have a price. They pay a coupon payment, which is usually a percent. So it's an interest percent. And then they have a end date or a maturity date. All right, so let's describe a bond transaction. Now let's say that the face value of a bond is $1,000. Let's say that the bond is selling at face value $1,000. Let's say that the coupon is 10%. That's extremely nice, by the way, in today's 2020 interest rates. And then maturity is, say, 3 years. So let's try to describe this transaction. All right, so the way a bond kind of works is, imagine that Professor Choi has a corporation and I want to borrow money. But I don't want to borrow money by going to the bank and asking the bank for money. I want to ask you, the individual person, to give me some money. Or I want to ask individual investors to give me money. I don't want to go to the bank. So what I could do is I can create my Choi bond. Okay? Now, on day one, what happens is you got to give Choi $1,000, and that is my price. So you got to give me $1,000 to get my bond. All right, now you own this security that makes payments to you. So on the first day when you get the bond, you just gave me $1,000. Okay? All right, so now how do you get your money back? Well, we have a 3-year maturity on this bond. So at the end of year one, so this is day one, but then at the end of year one, I gotta give you interest for this bond. And in this case, the interest is 10%. and 10% of 1,000 is $100. So I gotta give you $100. Then on year 2, at the end of the year, I again gotta give you $100 more. Again, that is the interest. That's the main reason why people buy bonds, to get paid interest. On year 3, I gotta give you the $100 that I promised. Again, that's the 10%. But because we are now on maturity year, I also gotta give you back at the end of the year the face value of the bond. Face value. And the face value of the bond is $1,000 in this case. Okay? So in nominal terms, by the way, not in real terms and not discounted. So in nominal terms, you're going to be receiving over 3 years $1,300 for your $1,000 investment. Again, that's on a 10% bond for 3 years with a price of $1,000 when you buy. Okay? So that's why people buy bonds, because basically it pays interest, and then at the end of maturity, you get your face value back. All right. Now, a stock is basically ownership in a company. So a stock gives you the right to vote for things that are happening in the company. If you own enough stock on a company, you might be able to be on the board, make decisions from there, etc., etc. So a stock is what represents when somebody is an owner of a corporation. If you have a small corporation, normally you are 100% owner of that corporation. Or there might be 2 or 3 people who own the corporation, and then everybody is a majority owner on that particular corporation. Now, if you are a publicly traded corporation, not a private corporation, a publicly traded corporation, then you can buy and sell those stocks in the stock market. All right, so let's say you wanted to invest on Ford Motor Company today, for example. This is how much you got to pay today to buy a stock in Ford Motor Company. You wanted to invest on Tesla Motors, for example. Then, as of the moment where I did this is how much you would have to invest on Tesla Motors to buy a stock in that company. All right, now sometimes stock pays you dividends. For example, the stock of Microsoft pays a dividend. A dividend is a payment to the people who own the stock. This is the amount of dividend that the Microsoft stock pays as of April 14, 2020. Now, this will be paid yearly. Usually they pay it every quarter, so they pay a quarter of this every quarter. But this is a yearly dividend on this particular stock. Now, all companies don't pay dividends. Some do, some don't. All right, now what exactly is the purpose of the stock market, and why do we need banks? And let's talk a little bit about basic finance, or the basic transfer of money in a financial system. So the purpose of financial intermediaries is to transfer money from the people who have it, aka let's call them savers, to the people who need it, let's call them borrowers. So a financial intermediary is basically a middleman between savers and borrowers. There are 2 basic ways to transfer money from savers to borrowers in the US financial system. One is what we call indirectly. So indirect finance. And another one is what we call direct finance. So again, there are two basic ways to move money from savers to borrowers. One way is what we call indirect finance. Another way is what we call direct finance. In indirect finance, you have your banking institutions or your commercial banks. Now, commercial banks come in two flavors. You got your for-profit commercial banks, and these are your Bank of America, your JP Morgan Chase, your Wells Fargo, and then you have your non-profit banks, which are also known as thrifts. Now, thrifts come in three flavors in the US. You have your credit unions, savings and loans, and your mutual banks. All right, now the reason we call these indirect finance is because you're transferring the money indirectly from savers to borrowers. So you're not dealing with the borrower at any point in time, you're just dealing with the financial institution. So in indirect finance, the money is being transferred indirectly. So savers usually show up to the bank and they open a bank account. Usually a checking account or a savings account. Alright, those are the most common. So basically you put your money in the bank. Now what do you use the accounts for? Well, you use them to like pay bills, transfer money, have access to cash, etc. Safety, so you don't have to basically have all this money around you all the time. Now what do the bank basically does with your money? Well, they take your money and they lend it to borrowers. So they create bank loans. Now those loans again come in many flavors. Mortgages, car loans, credit cards, personal loans, etc. And those are all the different types of things that you can get when you go to a bank and you want to borrow money. Now again, notice that what you're basically doing, and I guess he's oversimplifying it, but when you get yourself a credit card, what you're basically doing is you're borrowing money from yourself and everybody who has money on that particular bank. So the bank takes these accounts and they sort of package them into these loans. All right. Now what exactly is direct finance? Well, direct finance is when you deal with, for lack of a better word, Wall Street or brokers. Now these have multiple names as well. So when you're a saver and you want to put your money on this kind of way, a lot of the times people don't call you savers anymore, you're an investor. So now you are investing. Alright, now how do you invest? Well, there are multiple vehicles today, but the most common is to have a retirement account. Something like a 401k or a 403b or an IRA or a Roth IRA are very common. Another way is to have an individual brokerage account. And this is when you could buy stocks, bonds, ETFs, mutual funds by yourself. All right. Now, if you're a borrower and you want to participate in this, then what do you normally create? Well, you can create stocks, bonds, collateralized debt obligations, credit default swaps, all these, let's call it financial securities. Now, sometimes you can package a lot of these into things like ETFs, exchange traded funds, or mutual funds, or others, ETNs, etc. So there are lots of different financial securities that you can purchase. Now, what is the difference again between indirect finance and direct finance when it comes to the money? So the risk in indirect finance is all really being taken by the commercial entity, by the bank. So the loan defaults, they're the one in charge of collecting it. They also have to make sure that your account is working. When you're in direct finance, the person here in the middle is basically just like the person who puts this market together with this market, and then you are the one who takes the risk. So the broker is just there to create the transaction, but the risk is being transferred to you as soon as the transaction happens. The broker is just like the middleman to make it happen. The good news also, of course, because you get the risk, you also get the reward. So if your investment goes well, you make money. If your investment does not go well, then you lose money. Okay? So when you're participating on this portion of the market, you take the risk, but you also take the reward. The broker is just the middleman creating the transaction. It's very similar to when you purchase a house. So you purchase a house by talking to a real estate agent. Okay? And then that real estate agent is usually connected to a broker. The broker is the one that does all these transactions, while the real estate agent is a salesperson who's basically showing you, the house and things like that. And the broker is the one that connects all these other things that need to be connected in order for a house to be sold. All right. Then on the day that you want to close on your house, you normally talk to the title company, which is somebody that the broker hired, okay, or you hired, and then they basically make you sign all these papers and all that stuff, and then you get the house. All right. Notice that this entire structure disappears right after you get your house. So it's not like if the price of the house goes down, you talk to them and they kind of give you the money back or something. It's not like that. So they show up in order to make the market happen, and then right after that they leave. So it's very similar to here. In direct finance, you have all these intermediaries that allow you to do the transaction, but you're the one who takes the risk and you're the one who takes the reward. And those are the two basic ways in which money gets transferred from savers to borrowers. Now, believe it or not, this system is extremely important because it creates liquidity. Companies on this side need money. Let's say you want to find a vaccine for COVID, or let's say you want to find a better treatment for COVID. Let's say you want to find the next battery technology and so on. So there's a lot of these different projects that anybody at any time wants to create, and they need all this money because a lot of the times they may have a really good idea or really good working really good working business, but they need more funds in order to grow. And savers could be somebody who has lots and lots of money, or it could be somebody who has little money, and then the financial system is the one that basically generates that flow. So the financial system is extremely important for a well-functioning economy. If you're interested, by the way, one of the largest markets that you can participate on is called the stock market. And in the stock market, you basically buy and sell stocks. The largest stock market in the world is in New York. And it's not the NYSE. The NYSE, by the way, last time I checked, is the company who owns the building. And they usually trade about 15 to 20% of all the stocks in the market. NYSE stands for New York Stock Exchange. So, but it is a place where dealers go and exchange stocks and bonds. Now, these stocks are usually organized in indexes, and the indexes represent something. So the Dow Jones Index is maintained by a company called Dow Jones, and they have been keeping this index for longer than 100 years. And the Dow Jones Index is one of the most quoted indexes out there. Now, the Dow Jones is composed of multiple companies. And these are the companies that are currently included in the US Dow Jones Index, which includes 30 companies. Now, in the stock market, you have thousands of companies. So these are just the 30 that are included in the Dow Jones Index. Okay? Another index that's highly quoted is the S&P 500. All right, and again, these are the companies that are included in the S&P 500 index. Notice that the S&P 500 index is more of a technology index. And the Dow Jones is more of an industrial index, industrial services. All right. The NASDAQ, by the way, is a composite index. The NASDAQ is basically where most stocks are being traded today in the US. It's a system of brokers that basically have connected all of their networks together. So the best way to describe the stock market is, if you think about, it's very similar to like the Amazon marketplace. You have all these different people. So you have all these different brokerage companies out there. All right. And they have clients at any point in time put in bids and asks for companies, and then they share all of that so the networks are interconnected, and you and I buy at a particular price things. They buy too, by the way. So basically it's an interconnected network of all these different brokers and people who sell in the stock market, and all these different buyers that work with these brokers, and then they all connect all their sales and all the purchases into a system, and this system is the one that you and I see as the stock market. So it's basically an interconnected system of transactions. Again, when you buy stock, as I mentioned before, you become a part owner of a company. That's what it is. So when you buy stock, you either own a company or you own the future revenue of the company, because there are different types of stocks you can buy, common and preferred. All right. If you're interested on learning a little bit more about this, I would recommend taking a couple of accounting classes. The 2 intro classes normally give you enough information about how financial statements work, because financial statements are the way in which you know how the company is operating. And if you are not familiar with how financial statements work, a lot of the times you really have no clue what you're buying. So understanding income statement, balance sheet, statement of cash flows, etc., is extremely important for you to understand the financial standing of a company. I do want to talk a little bit about the difference between accounting profit and economic profit. So in economics, we normally tend to have not only implicit costs, but also explicit costs, while accounting usually only takes into account explicit costs. So accounting looks at transactions that actually happen, checks that have been written, things that have been bought, things that actually happen. Economic profits also talks about implicit costs. Sometimes these costs are not costs that you can see. So that may include all types of opportunity costs, which is something that you may or may not be able to see. So implicit costs are included in economic conversations, while they're not included usually on accounting conversations. This will not be the first time, and it will not be the last, where companies lie to us in the stock market and in financial in general, in finance in general. So if you're interested again on learning a little bit more about how this works, you also need to start learning a little bit more about corporations and when they really go wrong and they lie to a lot of people. So examples of that are companies like Enron, WorldCom, lately another company called Theranos. You need to look into them. Okay, so you should learn about Charles Ponzi. Last time I checked, there's a YouTube video on Charles Ponzi. Okay, that's the original Ponzi scheme. So learn a little bit about how corporations can lie to people and pretend that they have all this money, etc. Somewhere around the year 2002, due to the dot-com bust, and the dot-com bust was kind of like the end of the 1990s era in the stock market, which created a crash in the market, we passed something called the Sarbanes-Oxley Act of 2002, which requires the CEO of companies to personally certify the accuracy of financial statements, or say that they have expertise on those financial statements. All right. The Sarbanes-Oxley Act also requires a few other things, by the way. Creates, for example, an accounting oversight board. But for economists, usually the biggest portion is that now we've made it criminally wrong to lie in financial statements. All right. I hope this was another good chapter for you. Again, this chapter was about firms, stock market, and corporate governance. Have a good one, and this was Professor Choi.